I've seen, and I'm sure you have, plenty of articles covering this new budget. And unfortunately, for those who might not be in this financial world, there's been lots of use of jargon and maybe terms that not everybody quite understands. So if you want to fully be able to understand that in simple terms, as well as also how to maybe avoid some of the pitfalls that we came across with this new budget, be sure to stick around for this video as we break it all down. But first off, if you're new here, my name's Ross Kelly. I'm a diploma holder in regulated financial planning, and my aim here is just to simply give you the information that you need in a clean, digestible and understandable way so that you can make the best decisions that you can for your own financial future. Now, this new Labour budget, it brought on a lot of different changes. They didn't bother going for changing one tax a decent amount to bring in the revenue. They've decided to do lots of little tiny changes. So for this video, we're just going to cover from a financial planning and budgeting perspective what you need to bear in mind moving forward. So to start off, we're going to first cover the change that I think is going to be the biggest impact for the most amount of people. And well, that's targeting exactly what the Labour manifesto said that it wouldn't hit, and that's working people. And the way that this change, or more fittingly not change, is going to hit these people is actually quite sneaky. And you've probably seen the term being thrown about quite a lot in articles, and it's called fiscal drag. But what exactly is fiscal drag? You see all these mentionings of it, and while these articles do their best to explain it, I think it can be lost in translation a lot of the time. To understand fiscal drag, you need to understand tax bands. And tax bands are simply the levels at which your income beyond that point are going to be taxed at a new level. And again, that might not exactly come across very clear, and even when I say I understand that, so that's where the handy jug's going to come into play, because I think that this here can be a really good illustrator of how taxes actually work in the UK. Okay, there we go, cutting away. Oh, the production values really went up in recent times, that's for sure. But as you can see, I've sectioned the jug off into 3 sections. Let's say that the first section, the bit below the first bit of tape, is your personal allowance. That's where you don't pay any tax. So if, for reference, that's £12,570. So if you earn anything below that, you're in this wee bit and you pay no tax on that amount. The bit in the middle, we'll say, is the basic rate of tax. Anything in between the 2 bits of tape, that's going to be taxed at 20%. And the top, anything above the top bit of tape, is going to be the higher rate of tax, which is 40%. In the UK system, there's also normally the additional rate at 45%, and the Scotland system, there's actually more than these ones as well, but my jug isn't big enough to do that, so you're just going to need to stick with it. Come to think of it, I think a lot of the world's problems would be solved if there was just bigger jugs available for all. But I digress. As I pour the juice in, and yes, it is juice, get your head out the gutter, that represents how much money you're making. And it works up through the bands as you see. At first here, at the first level, the juice is below the first bit. So there's no tax being paid on any of this as a result of it being below your personal allowance. As we pour more what is definitely juice into the jug, you can see it's now taken beyond the first bit of tape. So that's it in the basic rate of tax section now. And as such, the money is starting to be taxed at the basic rate of tax, but only the amount that's in that section. All the money that's before that section is still not taxed. So even though there's a bit of juice into the basic rate section, everything below the tape is still not taxed. It's only the bit that's above the first bit of tape that's being taxed. And so now with the last bit of my Robinson's Reserve being poured into the jug, we can see that it's now being brought beyond the second bit of tape as well. So that's it moving into the higher rate of tax now. So everything beyond this tape is now getting taxed at 40% as well. I think this picture, this lovely jug analogy here, is a good indicator of how the tax system actually works and how some people get confused by it. As some people do think that once you hit a certain level of income, all of your money is now taxed at that higher amount, when in reality, it's only bits of your income that are taxed at certain amounts. So as we can see here in the jug, the very bottom amount would be getting taxed at nothing because it's under the personal allowance. The bit in between the two, that's getting taxed at 20%, and then any of the money above that is getting taxed at 40%. Which admittedly does seem a bit complicated, but it's obviously to discourage people who would just stop working if they get to a certain income threshold. Because obviously, if all of it was taxed at a higher amount, you hit a certain level of income, you would now be getting taxed. Or you'd rather be taking home less money. And no one wants that. While this has illustrated the UK tax system, how does this relate back to the fiscal drag and the changes, or rather not changes, that Labour are making? Well, to explain that, I'll pass it back to me in the studio. And by studio, I mean my living room. Thanks, post-production mate. That was a brilliant analogy, if I say so myself. I really do hope that came out okay in post-production. I'm sure it did. But yeah, a bit ambitious. But now, with that explained, how does this link into it? This links to fiscal drag, as before 2021, each year, normally, the income tax thresholds would increase by a certain amount, normally something linked to inflation. But this year, or since 2021 I should say, they've been frozen. And now with this new budget, they're going to continue freezing it. And again, this sounds quite technical, and you might not really understand how that is actually impacting you. And basically, it's because of inflation. And while inflation with jugs is normally a good thing for all, inflation when it comes to monetary amounts, that can become quite troublesome. Monetary inflation, or money inflation, basically just means that the prices of everything else is going up. So if you have the exact same amount of money, but the price of everything else goes up, it means you're able to buy less things as a result. So inflation basically takes away your ability to buy a certain amount of stuff with the same amount of money. And since 2021, obviously with the fallout of the pandemic, the total inflation to this point has been over 30%. To make this more understandable, again, we'll use an example. Imagine someone's being paid exactly at the higher rate threshold. So someone's bringing in an amount of income of £50,270. Let's say that wage, that's what they were earning in 2021. So again, if we were to think back to the jug, they're going to be about here. So they're not actually paying anything at 40% because there's nothing above the line, but everything below the line. So they're right a little bit of tape, and that means that they're not paying anything at the 40% rate. So for this example, let's just say that this person, they've managed to keep their wage in line with inflation, which admittedly is a bit of a stretch, but bear with me for the example. So assuming that their wage in 2025, assuming that it was at the higher threshold in 2021, would be about £68,000 today. And yeah, that's pretty nice. Wouldn't scoff at an extra 18k. But now obviously that 18k is going to bring them above that bit of tape. That's going to bring them into the higher rate threshold. So that extra 18,000 will be taxed at 40%. Nothing else, as it's the extra 18,000 that he's gained that will now be taxed. And that's going to be about £7,200 extra in tax. But obviously, you might think that's not too bad a deal, because obviously they've still got the other amount left, so they've got more money, right? Well, sadly you'd be mistaken, because yes, there's been an increase in his wage, obviously. We also need to bear in mind inflation has also been going on at the same time, right? We'll use another example. I know I'm throwing a lot of examples at you, but I really do think it's the easiest way to understand this stuff and really understand how these changes will actually really impact you and a lot of other people in the UK. So we'll use the previous example. We'll say that guy in 2021, he had that 50 grand to spend, and let's say he goes out and spends it all at M&S. And again, I know he wouldn't actually have a full 50,000 to spend, because obviously that would get taxed, but for the sake of simplicity, we'll just say he has 50,000 to spend. So yeah, he walks into M&S and he fancies himself some organic bananas. So he goes in and he buys himself 100,000 organic bananas. He clears out the shop and probably a couple of square miles of the rainforest. So now the same person walking into M&S in 2025, it's taken him all those years to finish all them bananas, but he's now walked in and he needs another 100,000 bananas. So he walks in, but now he's earning £68,000. So he goes in and he wants to buy some bananas again. He wants to spend it all on bananas. So he walks in. How many bananas can he get? Well, because of inflation, assuming the bananas rose at the same price as his wages did, he can't buy any more bananas. He can actually only buy 100,000 again, as both his wages and the bananas have only risen in line with inflation. So, might sound like, well, he's not worse off. But in reality, we've still not taken into account, obviously, the tax that needs to be paid now on this new level of income. as that new £18,000 will be getting taxed at the 40% rate. So in reality, he doesn't have £68,000 to spend on his bananas. He only have about 61,000, give or take, to spend on his lovely bananas. So in reality, he's actually able to buy less bananas in 2025 compared to 2021, even though his wages increased with inflation, which obviously not ideal. Instead of 100,000 bananas, he'd only be able to afford less than 90,000. So should probably switch to Lidl or Aldi instead of M&S. Which, to be fair, I don't see why there's any stigma around that. I don't think there is as much anymore, to be fair, but I think Lidl and Aldi are brilliant. But with this rather high potassium example aside, I hope this has really illustrated the impact the fiscal drag will likely have on you and many others as a result of Labour freezing these income tax thresholds. And it's not for a small amount of time either, so this will be getting felt for years to come. And actually, according to the OBR, the higher rate thresholds in real terms should be £20,100 higher than they currently are. And well, that's a lot of money that people are paying more tax on. And obviously, Labour pledged to not hit or tax working people more. And well, I don't know who else is going to feel this more than working people. However you measure it, with statistics from the OBR or with examples using yellow berries, a lot of people are going to feel the pain with this. So you might be asking, well, that's rather doom and gloom. What can I do about it? And unfortunately, in reality, there's not really many options that can be done to avoid this. From a financial planning standpoint, there is two options you can use to maybe lessen the sting of fiscal drag, but you're still going to feel some reduction. And again, this isn't financial advice, so bear in mind your own situation and maybe go speak to a professional if you're unsure. First option is that you can arrange or pay more into a salary sacrifice scheme. Obviously, there's changes coming to salary sacrifice in 2029, which we'll get onto, don't worry. But this is an option open to lessening the sting of fiscal drag, as when you do your salary sacrifice, you're not paying tax on it. It's going straight into the pension. So as a result, you're not really feeling the effects of fiscal drag that much. You can use salary sacrifice to basically keep yourself below the new tax thresholds if your income's going up, so you're saving it more into pensions. But obviously, if you're doing that just to continuously keep below that threshold and everything else is still going up in price, even though you're not paying as much tax, your buying power is still going down, assuming you're keeping that same level of income. So while you're paying less tax, your budget's going to be a bit more stretched as a result. So do bear that in mind. Another option, which likely is less available to most people, is that if you're a director of a limited company, you can use other methods of taking in an income. So you might take a part of your salary as, well, a salary, and that'll be charged at the income tax rate. And then you could take a bit of a dividend, and that'll be at the dividend rate, and then pension contributions as well. And because it's at the marginal rate, you can obviously get quite precise with how much you're paying from each one. And that can maybe also lessen the sting of fiscal drag by shifting them about. But again, if you're keeping yourself below these thresholds for a level of time, inflation's going to rise on everything else, and you're going to feel the pinch. Now with what I would say was the biggest one, or the biggest affecting change, or again, not change, out of the way, move on to the next biggest that was in the Labour budget, and that's pension contributions, or more specifically, the salary sacrifice arrangements. Salary sacrifice is exactly what it sounds like. You basically give up a part of your salary, and that instead gets directed into your pension instead. And this was quite lucrative for both parties, as doing this would basically save on national insurance for both you and your employer. So it was a win-win in that front. And a lot of the time, employers would actually take the amount that they're saving on national insurance and pay it into the employee's pension as well, as they were going to pay it anyway. And obviously it builds goodwill and stuff like that. So it really was, for a lot of people, quite a lucrative setup for them. From 2029 onwards, employers will no longer get this national insurance contribution save for over £2,000. So as a result, it's not going to be as good an incentive for the employer's end. The amount of national insurance being paid by employers is already increasing this year. It's going up from 13.8% to 15%. So for employers with a lot of employees on payroll, this is really going to hurt. It's going to seriously, especially if a lot of them are on salary sacrifice arrangements, that's going to drastically increase the bill on that front. And you might think, this might be bad for employers, but at least employees are all right. But remember, a lot of the time, the employers were paying the difference that they were saving into the employee's pension. So as a result, that 15% that would be getting put into the employee's pension on top, much like my inhibitions when a certain Rihanna song goes on, that's going to disappear. Nothing else is really changing with regards to your annual allowance for pensions, as well as the ability to backdate payments so you can put in 3 years worth all at once. None of that's changing with the pension scheme. So with regards to what you can actually do about this, it's basically make it the best of the salary sacrifice as it is before the changes come in 2029. But again, if you're unsure, be sure to seek out a professional before you do any of this stuff, because if you get it wrong, there can be some bad implications for you, and you don't want HMRC at your door. Before we move on to the remaining changes from the budget, if you've enjoyed the video so far, be sure to drop a like. It really does help the channel out a lot. And while you're at it, if you want to keep up to date and informed with all things finance and financial planning, be sure to subscribe as well, as we'll continue to cover these types of topics on the channel and making sure that you can make your right decisions for your financial future. So them two changes covered before, they were quite big ones. Thankfully, the next ones I can fire through a bit quicker, as the implications aren't at least as bad for most people, and there's not a lot of nuance to them. So the next bigger change was the change to ISAs, more specifically cash ISAs. In the new budget, they're going to make it so that the maximum cash ISA contribution will be £12,000 instead of £20,000. Total ISA contribution limit is still going to be the £20,000. That's not changing, but just the most you can put into a cash ISA in any 1 year is going to be £12,000. So if you want to make up the other £8,000, that's going to need to go into something like a stocks and shares ISA as well. With the one caveat that if you're 65 or older, you can still put the full 20,000 into a cash ISA. But if you're under 65, again, it's that 12,000 for cash ISAs. With regards to this one, I do think the government's heart is in the right place. They want to get more people investing, as the stock market isn't as risky as people think it is. And in the long term, it's going to make them way more comfortable if they're able to get into the stock market. However, I will say, while this approach might be effective for some people, it's a stick approach, when in reality, a more effective one would be to use the carrot instead. Better education around this topic, I think, would go a much further way, as I'm pretty sure the biggest cited reason for people not investing in the stock market is, well, that they don't trust it and they think they're going to lose all their money. So if you take away their ability to invest fully into cash ISAs, then they're not going to just suddenly invest in the stock market, assuming nothing else has changed. They're going to find other cash deposits to put it into, whether that's current accounts or premium bonds, which admittedly is fine for the government because both of them will mean more money coming to them. So to be fair, it's actually a win-win for them. Either more people invest, less reliant on the state moving forward, or they don't, and then they get more tax from their cash. So maybe Rachel Reeves is a wee bit smarter than I give her credit for. Although before we move on, there's one other thing I'd like to bring up about ISAs that I was really sad not to see, was a change to the lifetime ISA. Not the contributions amount, I think that's more than fair, but in terms of the value of property that it applies to, that didn't see any change at all. The lifetime ISA can still only be used for properties that are valued under £450,000, which maybe when this was initially created was okay, but for that to stay at that level for as long as it has is not ideal, especially for people in areas in the south, like London, for example. Trying to find a house that's at that price is a very difficult endeavour for people who might be trying to get onto the property ladder for the first time. Speaking of property, there seems to be a completely new type of income introduced in this budget. We don't really know the details of it, but it seems to be just called something like property income. and that's coming in 2027. And what we know is that these rates will be 2% higher than your normal income thresholds. So the basic rate will be 22% instead of 20%, higher rate 42 instead of 40, and then additional rate will be 47 instead of 45. I don't entirely mind these changes, as obviously the housing market is not ideal, we'll say, so putting in some kind of things to curtail that in rent prices would be nice. But the issue, and admittedly we don't have all the details, so maybe they'll address this, but it seems to be only targeting individuals. And a lot of people who are landlords are people who've just inherited a house from one of their parents dying. So this only applying to people like that and not to these massive companies that hold tens or hundreds or thousands of properties. They also need to be paying some kind of surcharge in tax for this. Because if it's just individuals, that's a pretty bad change actually. And then dividend and savings income will also be seeing their tax rates increased by 2%, which main one being dividends there. So your small business owners or, well, even medium business owners, directors who might be paying themselves more of their salary in dividends as opposed to, well, a salary, they're obviously going to see their tax rate go up, which might disproportionately hit smaller businesses more. But, well, they just love getting more and more tax at this rate. And so the last tax I'm going to bring up is what people have dubbed the mansion tax. And that's basically a surcharge or an additional, what you can think of as council tax on properties that are valued over £2 million. The properties will be valued in 2006 and it'll be on a sliding scale from 2,500 to 7,500 extra they'll need to pay. Even though it sounds like a small number for people who have a £2 million house, I'm quite surprised they never went for a percentage, but I think they didn't want to scare too many people, I guess. But I think it's more so important for what it signals, as loads of people have been crying out for council tax reform, as it's just so broken. But this at least shows that they might be starting to try and look at it, as obviously the valuations for council tax were done in 1991. So they're bringing in a new system to value houses in 2026. So maybe this is more so a test run to see, more so a test run before they roll out on a mass scale to then make some changes to the current system. So overall, this budget, it was underwhelming in a lot of ways, but it was also very impactful in others. So it's kind of a weird paradox I've got going on, how they've managed to not do a lot, but then also make a large impact for a lot of people. Income tax threshold freeze will have a ridiculously big impact on people's disposable income, and that's before taking into account any of the other tax increases as well. And the salary sacrifice one does seem a bit strange, because the government are signalling that they want people to take their savings and their retirement savings more into their own hands so that they're not as reliant on the state, because whether you want to admit it or not, the state pension as is in its current form is unsustainable. So the fact that they're discouraging or making it harder for people to save for their retirement, it's a bit of a weird one. A government having this large a majority not making more radical changes to the tax system as a whole is beyond disappointing. It's not even necessarily the changes that let me down more than anything, it's the fact that, well, they've not really made many changes at all. We've not seen a government with this much a majority in a long time. So the fact that they're not grabbing the bull by the horns and making some massive overhauls, the easiest and definitely will win a lot of votes, so again I'm just confused, would be overhauling the council tax system. It's outdated, it's regressive, and just it needs a new coat of paint. So God knows why they're being so hesitant. They must think after the Liz Truss stuff, they're wanting to be very careful with the bond markets. But still, it's underwhelming. But I could sit here and moan, but it is what it is. We're stuck with this limp-wristed approach, so all we can do is play what's in front of us. But yeah, with that, be sure to like and subscribe, and if you think that the Labour government's handling of finances is bad, you should see some people on TikTok. Believe me, they're significantly worse than Reeves could ever be. So if that sounds interesting, be sure to watch this video here, and if not, until next time.